All right, this morning, we're going to talk a little bit about your risk-reward ratio and how that connects or how it should be dialed in to the probability of your setup. So, in other words, if you're trading, let's say a breakaway trade, you need to collect data and statistics on that setup and what its hit rate is. So how often it achieves its target in the form of a percentage. So let's say that you're trading a breakaway trade and it is 50% accurate. So it has a hit rate of 50%. 50% of the time it hits target, 50% of the time it doesn't. That basically means that you're going to need in order to be profitable with that probability, a 50-50 probability, you need a 1-to-2 risk-reward ratio. In other words, you're going to risk one apple for two apples, okay? And 50% of the time, you're going to lose. So you're going to lose 5 apples out of 10. You get out of 10 trades, you're going to lose 5 apples, but you're going to gain 2 times 5 on the other side. So you're going to lose 5 apples, gain 10 apples. You're 5 apples up, right? Because your setup, your breakaway setup, has a 50% hit rate. And you've dialed in your risk-reward ratio. So your target is 2 times higher than your stop loss, which means over time, those two numbers plugged in, over time, you're in profit, okay? So it's really important to understand the setup that you're trading, first of all, and its probability. If you don't have that information, then and you're just kind of winging the risk-reward ratio, then over time you're going to see your equity sort of do this, and it's going to be inconsistent, right? So you have to include some type of way to get feedback, and the way we do it is we use a very detailed trade blotter, especially in the testing stages, because you need that feedback. You run hundreds of trades, various setups. All right, then you're gonna, after a month, you're gonna go, okay, let's have a look and see what these different trades yielded. You'll filter out all the trades. Be like, okay, well, all these trend bounces on the 1 hour trend line. Wow, okay, well, there was a 20% success rate there, okay? But the risk reward was like 1 to 6. We were risking 1 apple to 6 apple. And that resulted in, oh my Lord, like 40% profit. Great. Let's filter all those ones out and see what the breakaways did. Oh my Lord, the breakaways had a 5% success rate and we were on a 1-to-1 for average, risk-reward ratio. And so, we lost heavily on those ones. We cannot trade that setup with the risk-reward ratio of 1-to-1. It doesn't work. Let's see if we change the risk-reward ratio to 2-to-1 at a 10%. No, it still doesn't work. Well, at 10%, out of 10 trades, 1's going to go through, okay? And 9 won't. So you're going to lose 9 apples, okay? That means that we're going to need at least 9 on that last trade, on that 10th trade, which is a 1-to-9 ratio. Now, to find a setup that allows a 1-to-9 ratio is rare. That's going to definitely a bounce on a trend line, a long-term trend line as well, a turn. So you can see where I'm getting at now, right? The larger the risk-to-reward ratio, okay, the less probability your setup needs. All right, if you can find a high probability setup with a high risk-reward ratio, great. The fussier you get, the better too. This is what I've learned. You have to be very fussy. So are you kind of understanding that your probability, the percentage, the chance that your setup is going to hit target needs to be dialed into your risk-reward ratio, which is your stop loss. So I enter here, I'm risking that, and I'm targeting that, all right? So if you start taking your trades early and you end up only cutting at a 1-to-1 ratio, you better hope that you're getting at least 50% hit rate. But if the setup that you're doing, you got it all perfect, you see it's coming down, it hits the trend line, it's a 1 hour trend line, there's a nice big move ahead, you should be able to get a 1-to-6 risk-reward ratio out of that, but you go in and every single time you see the green number and you just take it at 1-to-1. Right, but the problem is that setup statistically is not going to hit higher than a 20% hit rate. So 2 out of 10 will work, 8 out won't. But because you're taking the trade too early, you're not allowing the maths and the probability, the statistics to work into a profit. It's just you're suffocating your strategy. All right. And you'll find that if you use a trade blotter that is able to say, okay, well, look, out of all the trades you took early, these ones you went out too early and they actually went and hit profit, you lost like 40% this month. Then you can go, aha, I can increase my risk reward ratio on that setup now. And can you see how it's important to be able to capture the data, especially in the test phase, so that you have that feedback and you can make those adjustments. All right. And a good trade blotter is vital for that. It needs to be programmed, and you need to be dialing in as much detail as possible, from your mood to absolutely everything, the quantity, your risk reward ratio, when you left, did it go on to hit target, did it go on to hit your stop, if you went out with the manual exit, you need all these details. I have a trade blotter that I can email to you on request, and I can show you how to use it, but the point of this video is to illustrate how important it is to know what setup you're taking and what the probability of that setup going on to hitting targets is, so that you're able to dial in the risk reward ratio so that it works. And if it doesn't work, you've got to go, okay, well, the setup's not working for that risk reward ratio, let me move on. And so you're testing a whole bunch of strategies, taking the ones that are working, you're putting them in boxes, and over time, you're going to build up a strategy, okay? Guys, successful traders normally only trade one setup, two setups, and that's it. They'll just look for those setups, become experts in identifying those setups. And usually, all right, a very good formula is not more than 50% hit rate. You only need because the risk reward ratio is more important. You want to find a setup that has an incredibly high risk reward ratio and that works out 20, 30% of the time. That's it. You're cutting the losses very quick. Okay. And I personally have got, that's mine. High risk reward ratio. I let my trades run for hours, sometimes days, and then I'm hitting those high numbers. I only need 1 in 10, 2 in 10 to make a profit. That's it. All right. And so that's pretty much all there is to it in terms of the mathematical language of probability and what you're risking for what you're getting back. All right. Those two factors are dialed in together, and then you have to find the setup. And the only way you can do this is with a good trade blotter that plugs in all the data and gives you back the statistics. Once you've got your setup and you've got the numbers and you've got your strategy, you no longer necessarily need to keep the trade blotter so strictly. You do obviously need to find some way to store your data. I just use my my broker's platform for that, and then I take the data from that I need on a maintenance side of things. So in other words, I no longer need to filter setups out because I've already got my setup there. I no longer need to find the risk reward ratio that's working because it's all done already. I just need to stick to the plan, get the feedback that I need from that necessary to make small tweaks, and that's it. But especially in the test page, you need to plug in all that data, all right? And guys, that's about it. So my goal is just to hit a 20% success rate at 1 to 6 risk reward ratio, and I'm happy at that point. And it's not, it's a hell of a lot less work than going for a 1-to-1 risk reward ratio and then trading hundreds of times throughout the day and just like kind of hoping for a 50% hit rate. I just find it works way better for me. And I'm not going to lie, I think it does work way better for a lot more people than, micro trading also. I've done micro trading, which is more of a, just sort of even risk reward ratio, high numbers, shorter time frames. It's a lot of hard work and it's very stressful, and it kind of turns on that part of the brain that's like, it's not good, not cool. So this is just a way more calculated. You sit back, you're allowing the losses just to rack up, but you've got your growers that are just growing, racking up massive profits in your inbox, in your open trade. And so you might lose 4 trades in a row, 4 apples gone, but you've got one there that's grown to like 7, 8 apples. So you're happy. You'll just keep there involves a little bit of strategy going forward on how to manage your open orders trade as to your closed losses and when you need to actually shut down for the day. And that's risk management. That's a whole nother video. I just wanted to quickly go through risk reward ratio. If you have a setup that works 50% of the time, then you need at least a 1-to-1 risk reward ratio. All right. If you have a setup that works at least 10% of the time, you need at least a 9-to-1 risk reward ratio. 80% of the time, you can work with a 6-to-1 reward ratio. And I hope you see what I'm saying here. You need to understand the probabilities. How do you find the probabilities? You trade for a month and you trade and you take a setup and you trade that setup and you capture the data, and then afterwards on the trade blotter that I use, it feeds back that information in the form of about, I don't know, maybe like 21 different reports. It's all programmed in there. And the reports come back and they say, well, listen, you went out too early over time, blah, 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 blah. And it gives you the feedback you need to make the changes. You test it again for a month and again for a month and again for a month. And often you'll start out with 7 setups. So you've got to filter all the ones out that don't work. And it's a lot of work. It's a lot of time. Every single trade needs a report. You need to take photos of your entrances, your exits, every time you move, your stop loss, reasons why you entered, the fundamental reasons why you entered. So a fundamental analysis breakdown as well as a technical analysis breakdown in case there's any flaws in your analysis that you can pick up over time by processing that data. Okay, so it's all about feedback, guys. It's all about discipline. It's all about maths, stats. Luck has nothing to do with it. Okay, that's the good thing about it. It's just math. You just rely on the stats, man. Just rely on the stats. As long as you're taking the setup strictly and you know that setup has a probability and you know that your risk reward ratio is dialed in so that the probability becomes profitable, hey presto, you're a profitable trader now. All because self-discipline, all right, and learning how to plug in that data so that it becomes meaningful in the form of the feedback. Okay, so if you have any questions or if you would like a trade blotter or if you would like to just comment on anything that I've said, please feel free to. And yeah, man, have a good day, guys. And I will definitely be seeing you on Monday for my morning fundamental analysis of the markets. All right, enjoy your weekend. Cheers.